Hello, welcome to the Market Cover. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician. So happy to have you along for this version of the Market Cover. For those of you with us here in Central Indiana, we hope you're grinding out these cold days. And for those of you watching from Florida with a little reprieve here, what a great week to be out in the sun. But you know, we're just right around the corner from maybe hopefully some sunnier days, if not some warmer ones. So with that being said, we can get right into the market stuff. We're going to talk about earnings as we get to the tail end reporting season. And then Andrew's going to take a look at volatility and what that is showing and setting up for market events. So let's dive right in and start talking about earnings. So as we go through the first quarter where companies report their results from the fourth quarter of last year, what we've seen is very strong success. Last week, we talked about the Mag 7 and how those earnings have been good, but just not quite as good as they were at their peak coming into the middle of last year. So those have been stepping down a little bit. But if we look broadly at the S&P 500, just not the S&P 7 in that case, the earnings have beaten their estimation of earnings by a wide margin, almost 6%, something we hadn't seen since the fourth quarter of the prior year, which is also a good one. However, what we also see, so the black bar there is the earnings surprise. The blue bar shows you what the average performance was for the stock that beat its earnings, which actually underperformed the benchmark. So those stocks that were having such good earnings reports and beating by wide amounts were actually lagging the S&P 500. And what that tells us is that the market was largely expecting very solid earnings across the board. And we certainly saw a strong surge in stock prices coming into the year, could certainly be a piece of that. Put that in a mixed bag, and it's mostly a good thing that we see earnings broadening out. We'll need that to continue as earning value or S&P 500 valuations are a little stretched. You need the earnings part to continue to drive the market going forward. And so far, that trend remains intact. With that being said, I'll flip it over to Andrew to talk about volatility.
All right, thank you, Adam. So if you've been watching the market cover for several years or been a family that we've had the privilege to serve for several years, you may be for a little bit familiar with this topic. And this is looking at the VIX. Now, back in 2017, I wrote a paper that won the Charles Dow Award titled Forecasting a Volatility Tsunami. Now, I know the title is a little bit scary. I don't necessarily think we're having a tsunami of a VIX spike right now, but we are seeing the set up for that type of condition, for that type of environment to happen in the volatility market. And now I know I'm throwing around a lot of terms that might be a little confusing. Volatility, or the VIX, is essentially just a gauge for the S&P 500 of how much wiggles the S&P does. And typically we see the volatility index, the VIX, spike when we start seeing the market go down, as it's kind of a measure of the fear gauge by some commentators. It basically measures options activity and, again, is inverse to the S&P. So when the S&P 500 goes down, we see the VIX go up. And so the paper that I wrote in 2017 looked at common scenarios or situations to where it precedes these types of spikes in volatility and typically declines in the market. And what I found was that when standard deviation or just the daily movements of the VIX gets really, really small, like into a beach ball being pushed underwater, that it builds up this pressure that's just waiting to be released. And so that's what we're starting to see right now, unfortunately, in the market, to where we're not seeing a lot of activity in the VIX because the S&P 500 has been so calm for so long. And so we're starting to see a buildup of that type of pressure that eventually could create the opportunity, kind of open the door for a spike in volatility. And so the chart I brought today kind of shows that. On the bottom panel, we have that standard deviation, again, measuring the daily movements of the VIX index. And when it gets really low and to the levels that it is right now, I've plotted some pretty orange bars to show prior instances. And we can see often after these orange bars, we see large moves higher in the VIX. And again, that's just showing that there's a little bit of fear that enters the market as traders begin to rush to buy options for protection and things like that. And we start seeing a little bit more volatility in the equity market. And so this doesn't necessarily mean that we're required or we have to see a spike in volatility. It simply lets us know and puts us on alert that this type of environment can occur, as we very rarely see spikes occur in the volatility index outside of these types of situations. So it's something that we are aware of and we're conscious of, and taking certain actions in different portfolios to kind of prepare for those types of environments. But again, the market right now is still sitting near all-time highs. We're still seeing some good price activity, but we want to be watchful as we start seeing maybe a little bit of storm clouds develop for the equity market based off of what we're seeing in the VIX index and the options market.
Yeah, thank you. And we're really lucky to have Andrew on our team, really one of the, I would say in the country, the leading volatility experts. That's something he couldn't say about himself, but I will. So we're very fortunate to have that. So thank you. And thank you to all of you for giving us your time. If we can be of service, please don't hesitate to reach out and give us a call, 800-928-4001, or scan that QR code and do it electronically. Thanks and have a great weekend.